Based on recent developments in the global energy market and international trade corridors, something unusual is happening at the intersection of environmental policy and national security. We are currently witnessing a significant recalibration of priorities where the high-minded goals of the previous decade are meeting the hard reality of a world in a state of energy supply disruption. According to a recently drafted document from the European Commission, authorities in Europe are considering a move that would have seemed unthinkable just a few years ago: the potential suspension of penalties for oil and gas companies that breach EU methane emission laws. This isn't just a minor regulatory tweak, it represents a fundamental shift in how the West balances its climate commitments against the immediate need for heating, electricity, and industrial fuel. If we look closely at the timing, this draft comes precisely as the US government has been exerting pressure on the European Union to exempt American firms from these exact same rules. Why would the world's most vocal proponent of green energy transition suddenly consider hitting the pause button on its most stringent methane regulations? The answer lies in a complex web of geopolitical leverage and physical supply constraints. Think of it like a city trying to implement a strict noise ordinance during a major construction boom. Eventually, the need for the new infrastructure becomes so pressing that the rules are temporarily set aside to keep the project moving. In this case, the project is the continued flow of energy into Europe at a time when traditional supply routes are under immense strain. The draft explicitly suggests that sanctioning should be delayed until the situation is stable, and only resumed if the risk to security of supply is no longer present. This raises a critical question for the future of global climate policy. If environmental rules are the first thing to be sacrificed during a crisis, what does that say about their long-term viability in a volatile world? According to recent reporting, this regulatory softening is happening against the backdrop of a broader, more intense conflict in the Middle East. Recent US and Israeli military actions directed at targets in Iran have sent ripples through the global energy market, pushing Brent crude prices to hold steady above the $100 per barrel mark. While high oil prices generally signal economic pain, we are seeing a strange divergence in how the markets are reacting. On one hand, the physical disruption of energy supplies is raising costs for manufacturers and threatening global growth. On the other hand, the Dow Jones Industrial Average recently surged over 1,100 points, marking its best performance in over a year. This contrast suggests a massive curiosity gap in the market. Investors seem to be betting on a swift diplomatic resolution, even as the military reality on the ground remains tense. The core of this optimism likely stems from reports that Iran is currently reviewing U.S. proposals to end the conflict, even as the Trump administration maintains a posture of strategic positioning, threatening further action if a deal is not reached. This leads us to a key pattern recognition insight. The U.S. is increasingly using a carrot-and-stick approach that combines direct military pressure with high-stakes financial diplomacy. While the military handles the stick, the U.S. Treasury, led by Secretary Scott Bessent, is working the diplomatic channels. Bessent has recently urged China to use its influence to persuade Iran to reopen the Strait of Hormuz, a vital artery for global oil that, if closed for an extended period, would likely make $100 oil look like a bargain. But here's where the logic of global trade begins to clash with the reality of national interests. While the U.S. is asking for China's help in the Strait of Hormuz, it is simultaneously imposing heavy sanctions on Chinese refineries for purchasing Iranian oil. This creates a fascinating contradiction in incentives. We are asking a partner to help stabilize a global trade route while concurrently blocking their domestic companies' assets in the U.S. financial system. This raises an important question. Can a nation be both a diplomatic partner and a primary target of economic pressure at the same time? The data suggests that Beijing is reaching its limit with this dual-track approach. In response to the recent blacklisting, China has invoked its own anti-sanctions law, instructing its domestic firms to ignore U.S. mandates. This represents a significant step toward what analysts call legal decoupling, where multinational corporations are caught in a crossfire of conflicting laws, making it nearly impossible to remain compliant in both Washington and Beijing simultaneously. Think of this legal friction like two different operating systems trying to run the same piece of software. Eventually, the system crashes because the instructions from one side are diametrically opposed to the instructions from the other. For a global company, the choice is becoming binary. Do you follow US sanctions and risk being sued or shut down in China? Or do you follow Chinese law and risk being cut off from the US dollar? This isn't just a theoretical problem for lawyers. It has immediate implications for the cost of goods and the stability of supply chains that every consumer relies on. According to multiple sources, this escalating legal battle is one of the primary reasons we are seeing a shift in how trade agreements are being negotiated. EU lawmakers have just concluded a second round of talks aimed at narrowing differences with the US, with the next major meeting set for May 19 in Strasbourg. The goal is to provide additional guarantees that benefit citizens and companies on both sides of the Atlantic, but the shadow of the US-China rift hangs over every discussion. While these high-level geopolitical maneuvers dominate the headlines, a much quieter, more localized crisis is unfolding in the American healthcare system. The FDA has recently placed several critical neurosurgical tools, including patties, sponges, and strips on its medical device shortage list. This isn't a minor supply chain hiccup. The disruption is projected to last through the end of 2026. The cause is a massive recall by Medline Industries due to elevated endotoxin levels in their products. This provides a clear comparison to our energy dilemma. Just as we are realizing our dependence on specific energy routes, we are also discovering how fragile our specialized medical supply chains have become. When a single major manufacturer fails a safety check, it can effectively halt or delay critical brain and spine surgeries across the entire country. How did we reach a point where a manufacturing error in one facility can impact neurosurgery for nearly 2 years? This highlights a pattern of extreme specialization and consolidation in the medical device industry. We have prioritized efficiency and low cost to such an extent that we have removed the redundancy necessary for a resilient system. According to Karen Niven, a senior director at Premier, these are high-risk, low-frequency products, meaning there aren't many alternative suppliers ready to step in and fill the void. Hospitals are now being advised to focus on conservation, which is essentially a polite term for rationing. This means that a surgeon today might have to decide which patient is critical enough to receive a specific type of sponge, a decision driven not by medical need alone, but by the failure of a factory months or years prior. This brings us back to the broader theme of our current era, the tension between idealistic standards and practical survival. Whether it's the EU relaxing methane rules to keep the lights on, or American hospitals rationing sponges to keep surgeries moving, we are seeing a world that is forced to be more pragmatic and less perfect. The Federal Reserve, meanwhile, is watching all of this with a wary eye. The benchmark overnight federal funds rate target is expected to be held steady at 5.25%. While Wall Street is celebrating a 1,100-point jump, the Fed knows that $100 oil and supply chain disruptions in healthcare and manufacturing are inherently inflationary. If the costs of energy and medical care continue to rise, the dream of a soft landing for the economy becomes much harder to achieve. Consider the Strait of Hormuz factor as a primary driver of this uncertainty. If China refuses to help reopen the strait, or if Iran decides to maintain the blockade as leverage in its negotiations over the U.S. peace proposal, the global economy faces a structural shock that no interest rate hike can easily fix. This is why the U.S. Treasury's outreach to Beijing is so critical despite the simultaneous sanctions. It is a high-stakes game of three-dimensional chess where every move on the board, whether it's a drone strike in the Middle East, a regulatory draft in Brussels, or a factory recall in the Midwest, is interconnected. Based on current data, the next few weeks will be telling. We are waiting to see if the EU will explicitly grant the U.S. those targeted methane exemptions, or if they will hide them behind a broader emergency supply clause. We are also watching for Beijing's next move. Will they deploy specific reciprocal trade actions in response to the U.S. Section 301 investigations into their industries, or will they find a way to cooperate on the Strait of Hormuz to protect their own oil imports? The stakes couldn't be higher, and the margin for error is becoming razor thin. This leads us to a final pattern recognition insight for this stage. In an era of disruption, the most valuable asset isn't just capital or energy, it's flexibility. The nations and companies that can pivot their regulations, their supply chains, and their diplomatic strategies. The fastest are the ones most likely to weather the storm. As we look toward the middle of May, specifically that May 19 meeting in Strasbourg, the focus will be on whether the US and the EU can present a truly united front. If they can't agree on something as fundamental as methane standards or trade guarantees, it signals to the rest of the world that the Western alliance is struggling to maintain its internal cohesion under the weight of these external pressures. This raises the most provocative question of all. Are we witnessing the beginning of a new global order where bilateral deals and emergency exemptions replace the rules-based international system we've known for decades? The evidence suggests that the rules are currently being rewritten in real time. often in the form of quiet, draft documents and emergency directives. This transition isn't just about politics, it's about the very real, physical constraints of the world we live in. We are discovering that you cannot simply legislate away the need for fossil fuels or command the supply chain to be resilient overnight. It requires a long-term structural commitment that is often at odds with the short-term cycles of politics and quarterly earnings. As we continue to analyze the implications of these shifting alliances and supply disruptions, one thing becomes clear. The energy supply crisis the EU is bracing for isn't just a possibility, it's the primary lens through which all future policy will be viewed. And as we move deeper into this analysis, we have to ask ourselves, if the current peace proposals fail and the Strait of Hormuz remains a flashpoint, what is the next safety rule that will be put on the chopping block in the name of security? As we look closer at these shifting dynamics, we have to recognize that the suspension of environmental penalties in Europe isn't just a reaction to a temporary shortfall. It may signal a deeper structural pivot in Western policy. Think of it like a lifeboat that has spent years focusing on its carbon footprint, only to suddenly realize it's taking on water. In that moment, the priority shifts from the efficiency of the engine to the integrity of the hull. This regulatory realism suggests that the European Union is beginning to treat energy security not as a secondary goal of the green transition, but as a prerequisite for its very survival. Based on recent reporting, the draft allowing national authorities to pause methane breach penalties during supply crises creates a precedent where geopolitical stability is given legal precedence over climate targets. This raises an important question. If the world's most ambitious climate framework can be paused by a surge in energy prices, does that fundamentally change the risk profile for long-term green investments? According to multiple sources, the pressure from the US government to exempt its own oil and gas firms from these rules adds another layer of complexity. It suggests a strategic positioning where the United States is leveraging its role as a primary energy exporter to ensure its domestic industries remain competitive even as global standards tighten. This creates a fascinating pattern in transatlantic relations. While the US and the EU are theoretically aligned on climate goals, their economic interests are diverging as the US becomes a dominant energy supplier. This tension is likely what Bernd Lange, the chair of the EU Parliament's Trade Committee, was referring to when he spoke about defending the Parliament's mandate to provide additional guarantees for both citizens and companies. The upcoming meeting on May 19th in Strasbourg will likely be the arena where this friction between environmental ideals and export competitiveness is finally addressed. But the energy landscape is only half of the story. To understand the deeper structural shifts, we have to look at the escalating legal decoupling between the US and China. When China invoked its anti-sanctions law in response to the US blacklisting of its refineries, it wasn't just a tit-for-tat trade move, it was the construction of a parallel legal reality. Think of it like a game where two different referees are using two different rulebooks on the same field. For a multinational bank or global shipping firm, this isn't just a compliance headache. It's a fundamental threat to their ability to operate. If you follow US sanctions, you are now explicitly violating Chinese law. If you follow Chinese law, you risk being cut off from the US financial system. This creates a curiosity gap. How long can the global financial system maintain its current level of integration when its two largest players are effectively outlawing compliance with each other's mandates? Based on available data, this legal bifurcation is forcing a massive adjustment in how global supply chains are constructed. We are moving away from a model of just-in-time efficiency toward one of just-in-case resilience, but that transition is incredibly expensive. We see this play out clearly in the US Treasury's recent diplomatic maneuvers. Secretary Scott Bessent's urging of China to help reopen the Strait of Hormuz is a calculated risk. It acknowledges that despite the sanctions and the legal battles, the two economies are still physically bound by the same global trade routes. This raises a critical question. Can a shared interest in stable oil prices outweigh the mounting pressure of a strategic decoupling? The fact that the Dow Jones surged 1,100 points suggests that the market is banking on a yes, but the underlying data like $100 oil suggests the margin for error is shrinking. This brings us to the internal pressures facing the U.S. economy, specifically the Federal Reserve's current stance, holding the benchmark rate steady at 5.25% indicates that the Fed is in a wait-and-see mode, balancing the risk of a recession against the persistent inflationary pressure of high energy costs. This is where the Middle East conflict becomes a direct domestic concern. If the military actions involving Iran continue to disrupt supplies, the cost-push inflation from $100 plus crude oil could force the Fed's hand, making a pivot to lower rates nearly impossible. This creates a comparison worth noting. The US is essentially fighting two battles at once: a geopolitical struggle for influence in the Middle East and an economic struggle to maintain price stability at home. In this environment, even small disruptions in unrelated sectors can have outsized impacts. Consider the neurosurgical supply shortage that is projected to last through 2026. According to recent reporting, the FDA's decision to place neurosurgical patties and sponges on the shortage list following the Medline recall highlights a systemic vulnerability. These are what analysts call high-risk, low-frequency products. Because they are so specialized, there is very little redundancy in the system. Think of it like a high-performance racing car. It's incredibly efficient until one highly specific part breaks, and then the entire machine sits idle because no one else makes that exact component. For the medical community, the conservation of these supplies isn't just a clinical challenge. It's a symptom of a global manufacturing strategy that has prioritized consolidation over resilience. This raises a pattern recognition insight. The same forces of consolidation and specialization that made our medical supplies vulnerable are also present in our energy and technology sectors. When we rely on a single narrow strait for 20% of the world's oil, or a single manufacturer for critical brain surgery tools, we are trading safety for efficiency. The structural implication here is that we are entering an era of the new pragmatism, where governments and corporations are being forced to reinvest in redundancy, even if it hurts their short-term margins. This shift is inherently inflationary, which explains why the Dow's 1,100-point surge is viewed with such caution by long-term analysts. A rallying stock market doesn't necessarily mean the underlying structural issues have been solved. It often just means the market has priced in a specific diplomatic outcome. What happens, though, if that diplomatic outcome, the U.S. proposal to end the war currently being reviewed by Tehran, doesn't materialize? President Trump's threat of further strategic positioning if a deal is not reached suggests that the U.S. is prepared to escalate its economic and military pressure. This leads to a scenario-based thought. If the Strait of Hormuz remains contested, the supply crisis the EU is drafting laws for today becomes the permanent reality of tomorrow. In such a world, the U.S. sanctioned 300 investigations into Chinese industries take on a new meaning. They aren't just about unfair trade. They are about who will control the manufacturing of the next generation of critical technologies, from medical devices to green energy infrastructure. Beijing's response to these investigations will be a key indicator of how the next few years play out. Will they deploy targeted reciprocal trade actions, perhaps by restricting exports of materials essential for those very neurosurgical tools or green energy components? Based on current data, the invocation of the anti-sanctions law suggests that China is preparing for a long-term economic pressure environment. This reinforces the idea that we are moving toward a multi-nodal world, where different regions operate under different sets of rules, and trade only happens where those rules overlap. This raises a final, vital question. In a world where the rules of trade are being dictated by national security rather than economic efficiency, who are the winners and who are the losers? The winners will likely be the entities that can achieve a high degree of self-sufficiency, or those that sit at the intersection of these competing power blocks. The losers will be the industries and citizens caught in the compliance friction between Washington, Brussels, and Beijing. As we approach the May 19 meetings in Strasbourg, we should be looking for any signs of a grand bargain that can reconcile these conflicting interests. However, the limit of our current data suggests that the rift is widening. The European Commission's willingness to bend its own environmental laws to accommodate the energy crisis is a powerful admission that the old rules-based system is under extreme duress. As we look toward the end of 2026, the projected end of the medical supply shortage, and a potential turning point for energy transition goals, the structural implications are clear. We are witnessing the end of unfettered globalization and the beginning of a managed trade era. In this new reality, the cost of doing business will include a geopolitical premium, a permanent tax on global commerce driven by the need for security, redundancy, and legal protection. This doesn't mean the global economy will collapse, but it does mean it will function with a different set of incentives. The logic of the past 30 years is being replaced by the logic of the next 30, where a secure supply of oil or a reliable source of surgical sponges is more valuable than a marginal gain in quarterly efficiency. Looking forward, the most critical thing to watch isn't just the price of Brent crude or the latest Fed statement. It's the way these disparate events, a factory recall in Illinois, a drone strike in the Gulf, and a trade meeting in France are being woven into a new narrative of national interest. This isn't just a series of isolated crises, it is a fundamental reconfiguration of the global power structure. The real insight here is that we are learning to live with a higher level of friction. And the most successful players will be those who stop waiting for a return to normal and start building for the world as it actually is, complex, divided, and intensely pragmatic.